Kinds of Instruments, Parties, and Negotiability, Chapter 27. In this chapter, we're going to learn the types of negotiable instruments and what is required in order for an instrument to be negotiable. Negotiable instruments. What are we talking about here? If we think about where we started off in class, first we learned the types of property, personal versus real. Then we learned that we can take personal property and deliver it to another with an agreement that it will be returned, the classic bailment, or that it be transported, a carrier, or stored, a warehouse. Why did we learn about a bailment? We learned about a bailment because sellers use bailments in order to move their products to a buyer. We saw that when we looked at the sales contract, the transfer of personal property for a price. How do we get it there? Using our bailment. Then we looked at the warranties that come with the products, the obligations and duties of the parties as it relates to the contract. Now we're going to look at the money, how we pay for it, ways to effectuate that contract. Because in real business, people aren't pulling out cash. Target's not sending $10,000 cash to Samsung when they place an order for goods. What they're going to use are different, more sophisticated financial instruments. And negotiable instruments is the broad category for which some of these other instruments fall under. So negotiable instruments are a substitute for cash. Rather than send real legal tender, a business or an individual could execute a contract where they promise to pay or they make an order to pay, and then they send that document as payment. We're going to look at that. Why do we need negotiable instruments? Well, typically, as I mentioned a minute ago, it's really to help us to transact business without having to use cash. There are two types of negotiable instruments. Promises to pay, which breaks into two types of categories, the promissory note and the certificate of deposit. And then there are orders to pay, which include drafts and checks. So let's look at each of those. The first type of negotiable instrument is a promise to pay. The first example we'll look at is a promissory note. A promissory note is a written promise made and signed by the maker to pay a sum certain to a payee. There are only two parties on promises to pay. That's one way you can help to distinguish a promise to pay from an order to pay. There are only two parties on the promise to pay, the maker and the payee. The maker is the party who is making the promise to repay the money. The payee is the person who is going to receive the money. So let's look at an example. This promissory note is dated March 31st. That is the date that the note was created. 6 months after date, undersigned debtor hereby promises to pay to the order of Galactic Games, Inc. $3,600 with interest at the rate of 10.9%. This note is secured by the video arcade games purchased with its funds. In the event of default, all sums due hereunder may be collected. Debtor agrees to pay all cost of collection, including but not limited to attorney's fees, cost of repossession, and cost of litigation. Signed, John Haldebrand, controller of Video Arcade. So what has occurred here? Video Arcade has purchased video games from Galactic Games. But Video Arcade is not sending $3,600 in cash to Galactic for this purchase. Most businesses would not do this. And in fact, most individuals wouldn't give that much cash either. So they're going to use an instrument. Now, whether or not that instrument is negotiable depends upon whether the instrument contains all of the requirements that we're going to go over. This is a promissory note because we only have two parties. The party making the promise, video game, who's promising to pay, and whom are they promising to pay? Galactic Games. So Video Arcade is our maker of the promise. Notice it's not John Haldebrand. John Haldebrand, as the controller, is signing this promissory note, but he's signing in his role as an authorized agent of the company. The party who's actually going to have to pay is the Video Arcade. Whom are they paying? Galactic Games. How do we know? Because in the first sentence, it tells us 6 months after the date. What date? After March 31st. So 6 months after March 31st, the undersigned debtor, Video Arcade, because that's the one who is signing underneath here, hereby promises to pay to the order of Galactic Games. So 6 months after March 31st, Video Arcade promises to pay to the order of Galactic Games $3,600 plus interest. Why would there be interest? Because if you're not going to pay up front when the goods are being delivered to you, then you're going to have to pay the interest on the money. Most businesses would do that. This note is secured by the video games purchased with its funds. So this is letting you know that in exchange for making this promise, that the maker of the promise received goods. And what were those goods? The video games. This is a promissory note. Now, later in this discussion, we're going to talk about the requirements of negotiability. If this promissory note does not contain all 7 requirements of negotiability, then this is just a regular contract. If it contains all the requirements to make it negotiable, then it is a contract, a promissory note that is negotiable. We'll talk about it. Here's our second type of promise to pay, a certificate of deposit. A certificate of deposit is a promise that is to pay that's issued by a bank. With a CD, an individual goes in and they deposit their money in the bank, and the bank promises to pay that money back to the customer with interest. So the bank is paying you to use your money. So if we look at this example, Factory Workers Local 888, certificate of deposit, it was issued on February 6th, has deposited the amount of $1,500. Who has deposited the amount of $1,500? Factory Workers Local. That sounds like a labor union. In a certificate of deposit account with First Federal, the term of this account is 18 months with a maturity date of August 6, 2001. This account will automatically renew at maturity. The interest for the account is a fixed rate. And then it goes on to tell us how much the interest rate is. Who are the parties here? Well, the payee is the Factory Workers Local. They deposited the $1,500, but they are being promised by the First Federal through their authorized agent, Tom Williams. They are being promised to receive $1,500 back plus interest. So with the certificate of deposit, the payee has deposited money, but they're going to receive that money back plus interest. Our second type of negotiable instrument is an order to pay. We've got 2 examples of orders to pay. The first is a draft. In an order to pay, you have an instrument where one party is being ordered by another party to pay a third party. So there are 3 entities in an order to pay. So an order by one party to pay a sum of money to a second party. And drafts are used as a means to obtain payment from buyers. So let's take a look at one. March 18th, 2020, 2 Oriental traders at Clarendon, Phoenix, Arizona. So this instrument, which we're going to know later is a draft, is being sent to Oriental traders. What are they being told? They are being told, pay to the order of Silly Putty the sum of $1,000. And who is it signed by? Joe Gilden for Silly Putty. The three parties in this instrument are the drawer, the drawee, and the payee. The drawer is the party who is giving the order to be paid. So Silly Putty is telling the drawee, Oriental Traders, release to the payee $1,000. In this instance, the payee is also the same party as the drawer because it's an invoice. So Silly Putty more than likely sent goods to Oriental Traders. And so this is a draft in the form of an invoice where Silly Putty is saying, Oriental Traders, send us $1,000 in payment for the goods that we have given you. So you can tell you have an order to pay because there will be three parties, in contrast to promises to pay where you only have two parties. You have the party making the promise and whom they're promising to pay to, the payee. In the orders to pay, you have three parties. You have the party ordering that a payment be made, the party that's being ordered to make the payment, and then the payee who's supposed to receive the payment. The payee and the drawer can be the same entity, and it will often be the same entity if we're dealing with an invoice. Here's our second example of an order to pay, a check. This is very common. You probably have seen this. A check is a draft, and again, it's got an order by the depositor, who's the drawer, payable on demand and drawn on a credit union or bank. The bank or the credit union is the drawee because they're the ones being told to release the funds. And then the payee is the party to whom the funds are being given. So let's look at our check. Mr. and Mrs. supportive parents have written this check that says pay to the order of Hale Charter Academy $500. So we've got the parents who want money to be paid to Hale Charter Academy. Who are they directing to make the payment? The bank. And the bank is going to pay Hale Charter, who's the payee. Who's the drawer? The parents, and they're going to sign it because they're the ones giving the order. And who is being directed to release the funds? The big bank, which is the drawee. I started this diagram with the payee because when you have orders to pay, it's often easiest to identify who the payee is. The payee is always the party receiving the money. So even if you're confused as to who the drawer is and who the drawee is, you can always figure out who the payee will be. The payee is the recipient of the money. The drawer is the one who is making the order that funds be released. Your bank does not tell you to pay people. You tell the bank. So the drawer is their name, their signature is going to be on the signature line on the front of the check. And the drawee is going to be the institution that's being told to release the funds. It could be a bank, it could be a credit union. Checks are very recognizable because we use them, but I want you to see that the draft we looked at was also set up in the same way. The difference with the draft is that the drawee, instead of it being a bank being told to release the funds, it's usually your customer. You're saying to your customer, if you're Samsung will say, Target, in exchange for the $10,000, I order you to pay us $10,000 for the 10 boxes that you received, payable at X date. Now, we've talked about the two types of instruments that can be negotiable. Well, what do they have to have in order to be negotiable? Several things that we're going to take a look at. The requirements of negotiability. So what must the instrument contain in order to be considered negotiable? First, it must be in writing. Evidenced by a record, that means in writing. It must be signed or authenticated by the maker or the drawer. Which one would it be? Well, it depends upon the type of instrument. If it's a promissory note, then it must be signed by the maker. If it's an order to pay, it must be signed by the drawer because that is who is making the order for the payment. It must contain an unconditional promise to pay or an order to pay. It must be payable in money. If payment is going to be made by supplying goods or a service, then you do not have a negotiable instrument. You might have a valid contract, but you don't have a negotiable instrument because it must be payable in money. It must be payable in a sum certain. That means there must be a definite amount of money that we can determine is going to be paid. It's all right if it has to be calculated so long as the calculation is obvious and people know what it is that they're going to be figuring. It must be payable on demand or at a definite time. And finally, the instrument must contain the words of negotiability. In other words, the instrument must be paid to state that it's paid to the order of or paid to bearer. So let's look at these each. The first requirement is that in order for an instrument to be negotiable, it must be in writing. Second, it must be signed or authenticated by the maker or the drawer. You will know which one needs to sign it depending upon the type of instrument. If it's a promise to pay, then the instrument must be signed by the maker. If it's an order to pay, it must be signed by the drawer. Now, it is important to realize most of these instruments are going to be often created by businesses. And therefore, when you have the signature, it must be signed by the agent and they have to reveal that they are a representative, they're acting as an officer of the company. For example, James Smith would sign if he is entering into a promissory note for his company, Aerotech, he would sign James Smith Controller, which shows he's an agent, and then Aerotech LLC, which is the principal. That's who's going to be liable for the payment. If James just signs his name, James Smith, on a contract where it says that he's going to be paying $5,000 for goods received, if he does not write his capacity in the company he represents, then he's going to be personally liable for the payment. And nobody wants to be personally liable for the debts of their company that they work for. So you would always write your name, you're going to sign it, and then whatever your position is, and then print the name of the company. The third requirement is that the instrument must contain either an unconditional promise to pay or an order to pay. If this is not in the instrument, then it's not a negotiable instrument. It still might be an enforceable contract, but it's not a negotiable instrument such that it could be used for payment and sold and transferred between parties. The example of an unconditional promise to pay is simply the language, I promise to pay. The instrument must be payable in money and it must be for a sum certain. For example, I promise to pay $3,000. You've got your unconditional promise and now you've got it's payable in money, dollars, and it's a sum certain, 3,000. We know how much it is. Now, if it says I promise to pay $3,000 plus interest, but they don't include how much that would actually be with the interest, you still have a sum certain because if we know the interest rate, we can calculate it. The instrument must also be payable on demand or at a definite time. Payable on demand means that when the instrument is presented, it can be paid. That's on demand. At a definite time is when you state you'll be promising at a future date. For example, I promise to pay $3,000 on December 30th, 2020. So that's in the future, but it's a definite time. So if the promissory note I wrote says I promise to pay $3,000 on December 30th, then I've met these elements of negotiability. Finally, the document must contain words of negotiability. This is purely a legal term of art. Words of negotiability. What are they? It's what the law has defined. And the words are to the order of, and then the name of the particular person, or payable to bearer. So we're going to look at this element more in depth. But here's an example. I promise to pay to the order of Smith Enterprises $3,000 on December 30th, 2020. This is in writing, and we're going to assume that I have signed it. I'm promising to pay, unconditional promise. And then when I insert the words to the order of Smith Enterprises, under the law, the term or phrase to the order of has legal significance. It makes this promise negotiable. If I had just written, I promise to pay Smith Enterprises $3,000 on December 30th, 2020, I would have an enforceable promise, an enforceable contract to pay Smith Enterprises $3,000. But only Smith Enterprises $3,000. When I put the phrase to the order of in this document, it enables Smith Enterprises to take this instrument and sell it to a third party. Instead of waiting for me to pay Smith on $3,000, it just pay the $3,000 on December 30th. If this instrument is negotiable, Smith Enterprises could sell it to someone else right now for a discount. Like they could sell it to a third party to finance things. Like, I don't want to wait, because you can consider this an accounts receivable for those of you who are in accounting, right? These are accounts receivables. These are assets. You've got promises to pay that people, customers are going who owe you money. You could, if the instrument is negotiable, sell it in the present to a third party who would hold it and wait for it to mature, and then they would collect the money on December 30th. But Smith Enterprises could sell it now in September or October and get a discount, because nobody's going to pay you exactly what it's worth in the present when they've got to wait to see if it matures. But maybe they could get $1,500 for this promissory note in September, and then the third party who purchased it from Smith Enterprises will get the $3,000 in December when it becomes due. Now, why would you do that? Well, Smith Enterprises may not want to wait till December 30th to get money. They might have, lots of bills and overhead and projects that they need money for in September. And so if they have these accounts receivables, these invoices coming in, and they've written them so that they are negotiable, they can use them to create cash flow that they would not otherwise have. It's a way to finance their business without getting loans. That's what the power of a negotiable instrument is. It allows the payee to take this money owed to them and transfer it to someone else in the present and let the third party wait for the money, and it allows them to create cash flow in the present. And that's all created by the insertion of these words to the order of, because what this is essentially saying is I promise to Smith Enterprises, or anyone that they direct the money to go to their order. So let's look at the type of instruments and parties again. Let's do a little review. For promissory notes, we have the maker and the payee. For certificates of deposit, we have the maker, payee. In our drafts, which are orders to pay, we have drawer, the drawee, and the payee, 3 parties. And checks, which are another form of an order to pay, have 3 parties. If you become confused as to which type of instrument you're dealing with, look to see how many parties there are. Promises to pay only have 2 parties, the maker and the payee. Orders to pay have 3 parties. Let's look at an example. Let's look at this one again. March 31st, 2020, 6 months after date, undersigned debtor hereby promises to pay to the order of Galactic Games $3,000 with interest. The note is secured by the arcade games. The second paragraph is a really good paragraph. It tells you what's going to happen if a party breaches. In the event of default, all sums due hereunder may be collected. So, if you breach, all of this money is due. If who breaches? The promiser, the maker of the promise, Video Arcade. The debtor agrees to pay all cost of collection, including attorney's fees, cost of repossession, and litigation. So in other words, if you, Video Arcade, fail to repay this money, you are also agreeing that we can add to this $3,600 with interest whatever cost that the creditor, Galactic Games, has to incur to enforce this instrument against you. So let's see if it's negotiable. First of all, it's in writing. It's signed by the maker. Who is the maker? It's Video Arcade, not the individual listed, not the individual controller. They're signing in their representative capacity. This promise to pay is being made by Video Arcade. Does it contain an unconditional promise or order to pay? Yes, where it says, hereby promises to pay. That's unconditional. They don't say we'll pay if we have the money. It doesn't say we'll pay if the games work. It says hereby promises to pay. So that's an unconditional promise. A sum certain, and it's payable in money, because what are they promising to pay? $3,600, which is a sum certain and payable in money. The fact that there will be interest added does not make this, does not change the fact that the sum is certain. We can calculate what the interest would be. Is it payable on demand or a definite time? Yes, because the first sentence tells us that it's 6 months after the date that the undersigned debtor. So what's the date that our reference point we're using? March 31st. So 6 months after March 31st, this promissory note is due. Does it contain the words of negotiability? Yes, it does, because the undersigned debtor hereby promises to pay to the order of Galactic Games the $3,600. So this does a couple of things. First of all of our elements of negotiability are met and are contained in this instrument. So this promissory note, in addition to being a valid contract, is also negotiable. What does that mean? Because this promissory note is negotiable, Galactic Games can sell this note to a third party to get money. It does not have to wait for Video Arcade to pay the money that's due. Galactic Games can use this promissory note, or you could think of it as an account receivable. They can use it as a way to finance other projects, other things they're working on. It's as good as money. That's why we talked about in the very first opening slide that negotiable instruments take the place of cash. Even though Galactic is not receiving $3,600 right now, they can sell this instrument to a third party as if it were money. Now, they're going to have to sell it at a discount. They're not going to get $3,600 for it if they're selling it in April. They might get, 2/3 or a quarter of it. But it allows them to get money in the present, and then the third party waits and holds the money. Now, you might wonder, well, why would the third party be willing to do that? We'll talk about why in chapter 29. Like, what's the benefit of this? But one of the reasons you can think of right now is they're going to pay a discount. So I'm paying, say, $1,500 for the right to get $3,600 in the future. If I do enough of these and I get my margin right, I can make money. So all of the requirements of negotiability are present in this instrument. What if we have some ambiguities in the instrument? What if there are problems? What are our rules of construction? If we have ambiguous language in our negotiable instrument, words supersede figures. So if in my promissory note I'd written in words $3,600, but the numerals had said 3,700, so that the parties didn't know, okay, well, which one is right. The court is going to go with the words. Similarly, if we've got handwriting on the contract and there's typing and printed terms and they don't all say the same thing or they conflict, the court is going to go with the handwriting. And then typewritten terms supersede pre-printed terms. What does that mean? Pre-printed is if you have a form that had already been typed, that form is used over and over again, but then the terms that were pertinent to this particular deal had been typed into the pre-done form, the court is going to go with the typewritten terms.